Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome to the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and founder of Zynergy Retirement Planning. And of course, as always, I'm here with my co-host, associate planner, the brilliant, the handsome Zane Belsack. How you doing on this lovely morning, Zane?
Brilliant and handsome. Now I'm doing great. Thank you, Ryan.
That's right. Get you going on this great morning.
I'm excited to learn more about today's topic. It's actually something I've been really interested in.
Today, we're really taking a plain English look at Roth conversions. We're going to try to break it down for you, try to use language that you'll understand. What are they? When they tend to help? How to size them responsibly? And which rules you absolutely need to respect when looking at a Roth conversion. As usual, we want to start with a story. This is the story of Helen and Victor. Helen and Victor are both 66 years old. They retired last year and chose to delay Social Security until age 70, so they had no Social Security income coming in for the time being. Most of their retirement savings sat in a traditional IRA, so it was pre-tax, meaning it was going to be taxed when they took it out to live off of it. When they projected their cash flow and taxes going forward, we saw that required minimum distribution, specifically as they pushed into their late 70s, would push their taxable income above what they needed to spend. In fact, far above. And it meant higher lifetime taxes and really less flexibility overall in their retirement plan. So we built a plan for this year's Roth conversion amount with a standing note to make sure that we reassess annually before we begin anything next year. The amount wasn't random. We first estimated the total income and deductions for the year, identified how much taxable income they could add before reaching the next marginal tax bracket, and then, of course, set conversions below that threshold. We also reviewed potential effects on Medicare IRMAA premiums and taxation for Social Security once they do start benefits to avoid surprises. After the first year of doing the Roth conversion, we then did a plan and realized that several things moved in their favor. First, projected required minimum distributions dropped. Their expected lifetime tax bill decreased, and they began building a Roth balance that not only grew and compounded completely tax-free every year. By the way, what's the best words in the English language, Zane?
Tax-free.
Absolutely. I personally like completely tax-free, but tax-free is the exactly same thing. Completely love it. But they can also now use that tax-free money to draw income from in the future. More importantly, if they have a large purchase that they need to make, instead of increasing their tax brackets to much, much higher levels, they can draw it from that tax-free pool of money. The key is that they now are in control of when they recognize their income and retirement savings, instead of being forced to recognize income based on RMD rules.
A lot of complicated stuff. So for our listeners out there that may not be financial planners or accountants, can you put this strategy in just plain English?
Absolutely. I really think that's our goal here. Before we dive too deep, let's take a step back and let's talk about the building blocks. Let's really understand the words we're going to be using here and the tools that build a Roth conversion strategy. So think of your retirement accounts like different buckets.
And why is it always buckets? Because I think it was in our tax episode, we described it as buckets as well.
True. Okay, good point. So let's shake it up a bit. How about this? Let's think about our retirement accounts like amusement parks.
All right, so now that sounds like fun, like roller coasters, right?
So yes, your retirement accounts will be like roller coasters, but not in the context we're talking about here. A traditional IRA is like an amusement park where you don't pay anything at the gate. So in your traditional IRA, you put your money in before taxes. The government doesn't charge you a dime to put the money in. Then you go into the park and you ride all day for free. There's absolutely no cost, which is great. But the catch is, when your day is over and you're walking out, the park charges you for everything you did the entire day as you're walking out. Oh, and by the way, plus interest. So think about it this way. I put all my money into a 401k, and every single year I'm putting it into a pre-tax 401k, $5,000 a year. So I don't pay any tax on it when I put it in or as it grows. So for 40 years, I decided to put in $5,000 a year. If I make $100,000 a year in income, I only show $95,000 a year on my tax return. It's a great tax deduction up front. Then that money grows and becomes worth $800,000 by the time I retire, which is a fantastic return, great investing. I took $200,000 over 40 years and turned it into $800,000. But the worst thing is, now I'm taxed on all $800,000 when I pull it out at my ordinary income tax rate. And worst of all, I don't control that. And what I mean by that is when I turn 73, I hit required minimum distribution age, which means the government says you have to take a certain amount of money out of your IRA, whether you need it or not, whether you want it or not, and you have to pay tax on it. And their point of view is essentially, we let you save all this money completely tax deferred. Now it's time to pay the piper. Now it's time to pay your taxes. So that RMD, the required amount you have to draw, actually grows each year between age 73 and then the age you die. So in the first year, out of the $800,000, you may only have to take $30,000. By the time you're in your 90s, you may have to take anywhere between $100,000 and $150,000. That $100,000 and $150,000 may be far more money than you need. So all you're doing is taking money out of your IRA, moving it to a taxable investment account, and just paying a big tax bill, which is something that we do for people on a regular basis, and it is not optimal.
And I know the word taxes really freaks me out, but taking money out forcibly, it seems like a good problem to have.
Yeah, of course. Too much money in retirement? Oh, the horror of it all. I totally get it. And people say to me all the time, I'll deal with that problem when it comes. That is not my biggest concern. Most people are concerned about running out of money in retirement, and I get it, but it is still a problem. We see it with people in their 80s and 90s who are taking money out, and some people even in their late 70s who are taking far more money out than they need, and their tax bill is extremely high. And now it pushes them into higher Medicare premiums, higher Social Security taxes, all these various things. So let's now talk about what a Roth IRA is. A Roth IRA is like the amusement park where you pay a small fee to get in at the very beginning each time you go. Once inside, you can ride all the rides as much as you like, as often as you like. Then, in our little imaginary amusement park, once you hit a certain age, and we'll say that age is retirement, you now have free lifetime access to that park for the rest of your life. You pay the entrance fee up front one time, you put the money in, but once the money is inside, it grows tax-free and you never pay tax on it again, even when you take it out. In the same scenario, if I put in $5,000 a year into a Roth IRA, or a Roth 401k for that matter, and I would pay taxes on that $5,000 each year. But if in 40 years it's worth $800,000, that $800,000 is completely tax-free, right? Because I paid tax on the $200,000 that I put in $5,000 increments, but the $600,000 in growth to create $800,000 is now never taxed. I didn't pay a dime of tax on the $600,000 when I put it in, while it was growing, or when I took it out. And all that $800,000 sitting in the account is completely tax-free to me. It's not even recorded on my tax return. So it doesn't affect anything else that may be impacted by your income.
That makes sense. And I really like the amusement park scenarios. So the traditional IRA seems to save you money now, but the Roth saves you money later.
And it saves you a lot of money later. So even though you're paying taxes now, the rule of thumb in financial planning, especially in the mind of our members, is, well, deferring taxes is a good thing, but we don't always agree with that. And although in theory that's true, I'd much rather pay a much smaller tax now to have completely tax-free control over my money later than to defer taxes and then lose that control and pay larger taxes later. So now what we want to do is pivot to the entrance fee, or the taxes here that we're talking about, which is based on tax brackets. As we discussed in our podcast on taxes, we have what's called a progressive tax system. So each level of tax or tax brackets must be filled up before we can move on to the next one.
Hey, like a bucket.
Yeah, that's exactly right. We're going back to the bucket analogy. I'm just going to have to use it. It's just like a bucket. So even if you make $500,000 a year, if you're married filing jointly, your first $23,850 is taxed at 10%. That's the exact same amount of tax that someone who makes $50,000 a year is taxed at. The next $73,100 is taxed at 12%, and so on. Most people think when I hit a new bracket, all of my money is taxed at that level, but it's not exactly true. It's a progressive system. These buckets must be completely filled before your next dollar of earnings moves you to a new bucket or bracket. Typically, as a general rule, we love to fill our buckets by converting without spilling into the next bucket. Essentially, we want to utilize the entirety of the current bracket that we're in.
So Roth conversions are about being strategic with which bucket. Honestly, I'm going to stop saying bucket. I'm just going to say bracket. Which bracket you're in when you pay taxes.
Right. But here's where it gets tricky. We're actually proactively and purposely creating higher income on an annual basis, which can also affect other things in our income tax. So things like Medicare premiums, if we're 65 and older, Medicare has something called IRMAA. It's like a surcharge. So imagine flying in an airline and you are going to check your bags. But if your bags are too heavy, you pay an extra fee. And that fee is tiered up based on the weight of your bag, right? Medicare is the same. With Medicare, if your income climbs over a certain threshold, you pay an extra premium for Part B and Part D, sometimes hundreds of dollars a month, and it can be pretty expensive.
Not only do we have to think about the tax brackets, but also the weight limits of Medicare.
And Medicare is not the only thing that we have to think about, and it's why our conversions are measured so carefully. Doing too little and you're wasting opportunity to convert at potentially really low tax rates, and doing too much and you could trigger higher taxes that were inadvertent that you didn't even think about on Medicare surcharges. There are also additional things to consider because capital gains and dividends have their own tax structure. And if you're below a certain income level, you may actually pay nothing on your capital gains or dividends. If we proactively convert and push you into a higher bracket, now we're triggering taxes on those capital gains and dividends. So we have to look at that, and then taxes on your Social Security. So now that we have the basics, let's start describing a conversion. And in a nutshell, a Roth conversion is withdrawing assets from a traditional IRA or a traditional 401k. We typically say IRA because when somebody retires, they'll roll over their 401k to an IRA. And usually that's where we're doing conversions from. But it could come from a 401k as well. But a pre-tax traditional IRA or 401k, money is withdrawn and it's placed into a Roth IRA or Roth 401k. Now, we don't want to directly withdraw it. We actually want to convert it. But that's essentially how it's done. The amount converted is taxed at ordinary income in the year it's converted. So it's just like you went out and earned that money in that year. If I convert $100,000 this year, it's as if I earned $100,000 at my job. And after that, qualified withdrawals from the Roth IRA are tax-free, and there's no RMDs to the original owner. So that's where the power comes in.
A couple of quick notes as well. So first, conversions are different from contributions. There's no annual dollar limit on conversions, but you'll actually owe income tax on the amount you convert. And second, this is really a timing decision. You're choosing to recognize income now to reduce or eliminate taxes on those same dollars later.
Yeah, spot on. This is a very sophisticated strategy. So we ask people to proceed with caution and be careful in how you're doing your calculations. It must be analyzed really closely. There are a lot of moving parts, and we just don't want you to make a mistake.
And here's a question. Why can't people just convert all of their money now?
It's really a good question. First of all, we don't want to obviously convert into higher brackets, right? So converting all your money right now means that potentially $500,000 of your 401k is going to be converted at 37% tax bracket and maybe an 8 or 9% state bracket. Giving 50% of your money to the government is certainly not advantageous. The goal is to move the money in low brackets. But more to the point, we don't want 100% of your money in Roth IRAs. Is it the worst thing in the world? No, it's definitely not the worst thing in the world. But we want what we call tax diversification in your retirement. We like to have a model of roughly 2/3, 1/3. So roughly anywhere from 65 to 70% of your money ideally should be in Roth. We say should be in Roth if we can get it there. And that's what we're going to continue to try to convert to hit that 65 to 70% because that gives us that tax diversification. We have some money that is pre-tax that will be subject to an RMD, but not necessarily a problem because those RMDs will be relatively small. We also have most of our money that is after tax, and because it's after tax, we can pull money in periods where we are pushing into higher brackets or income taxes happen to be high in those years. So we can take money from the Roth accounts for the most part.
I think it would be great to explain, where do conversions tend to help the most?
There's a few common spots. First, in the years where you have lower earned income, particularly we like the early years of retirement. If you do happen to retire and you're not yet collecting Social Security, there's that window before your Social Security or your pension starts where you may have very low income. Those are great years to do Roth conversions, great years to take advantage of those low brackets and convert money at 10, 12, even 22 and 24%. We like to convert as much as possible through the 24% bracket. Second, for households with large traditional IRA balances, there have been several households that we've dealt with that really struggle because almost 100% of their investment money, I know almost 100% is not 100%, but if 95% of your investments are in pre-tax accounts, anytime you need money, you're paying tax to get access to it. And that can be a problem when you want to take money to buy a car, right? So let's say you're drawing $100,000 a year to live comfortably in your retirement, and then all of a sudden you need to buy a $50,000 car. Guess what? Now your income is $150,000. That $50,000 goes right on top. So by doing some conversions along the way, and we can diversify that tax, when the time comes you need to take that big distribution, you need to buy a car, maybe some will come from your pre-tax account, but maybe the majority will come from your Roth. So we're not pushing up into higher brackets. We want that tax diversification. Those are the two types of people that we tend to help the best with a Roth conversion.
And what about legacies and legacy planning?
It tends not to be something that's high on people's radar, i.e., how can I save taxes in the future for my heirs? They're already getting $1 million or more. They're less concerned about them paying a little bit in taxes. But conversions help there because by prepaying the taxes now, you're avoiding those income taxes that your heirs have to pay. Most people think because the exemption on estate tax is $15 million for an individual, $30 million for a couple, they're not going to have any taxes to pay when they inherit. But if you inherit an IRA that's pre-tax, you're going to pay what's called IRD, income with respect to the decedent. You have to take that IRA over a 10-year period. If you have $1 million IRA that you're leaving to your children, and let's say one person inherits $1 million IRA, they have to take $100,000 a year over a 10-year period to get that money out. And in doing so, they're going to pay a much higher tax than you would when you're in retirement. So conversions are really helpful there. Beneficiaries receive Roth dollars that are tax advantaged. There are no income taxes when they take it, but there are subject to inheritance IRA rules. So there are a few rules we do have to respect and we want you to be aware of as part of a Roth conversion process. First is RMD sequencing. If you're already subject to require minimum distribution, you have to take your full RMD before you convert anything. And what do I mean by that? If I'm 73 years old and my RMD this year is $40,000, if you say I'm going to convert 100, so the first 40 will be my RMD and the next 60 will go into my IRA. It doesn't work like that, unfortunately. You have to take your 40,000 out. That's your required minimum distribution. And then you can go and convert 100 or 60 or whatever you want. But the first 40 cannot go into an IRA. A Roth IRA cannot be converted.
So the order does matter, RMD first and then the conversion.
That's right. Second, there are no do-overs, so make sure you get your math right. We tend to wait till the end of the year to do Roth conversions, but we like to have our numbers planned early in the year so we know roughly what kind of conversions we're going to do in the year, and then we confirm it later in the year. The reason why we do our numbers earlier in the year is because if there's a really large market sell-off, which there tends to be in some years, 20% or more, we like to do conversions during a sell-off. We're able to convert more dollars at cheaper prices. And then when the markets do recover, all that recovery will be completely tax-free in the Roth. You cannot get a do-over, so make sure you have your numbers right. There is no what's called recharacterization. You can't move money back into a traditional IRA. If you over-converted, you are stuck with your decision.
That sounds really rough for someone who would convert and then have the market drop right after.
Yeah, it would be because it would be better to convert after the market corrects, but you can't undo it. That's why we size the time and conversions carefully, not reactive.
And what are the 5-year rules I always hear about?
There are two. One is for Roth earnings to be tax-free. You need a Roth that has been open for 5, at least tax years. You generally need to be 59 and a half to meet the exception. The other rule applies to converted principal. If you're under 59 and a half, each conversion has its own 5-year tax clock to avoid the 10% penalty. If you're over 59 and a half, that second clock usually isn't an issue, but the earnings rule still applies.
And conversions can affect other parts of someone's plan too, right?
Conversions can increase your income, we call it your adjusted gross income, your AGI. And this can have an impact on, of course, Medicare premiums, Part B and D, which we talked about through your IRMAAs. And it can change how your Social Security is taxed, which Social Security is a very tax efficient way of collecting income. And if we're proactively increasing our income, it can be taxed at higher rates for sure. And of course, capital gains and dividends, which we talked about. And then there are certain deductions that phase out when you hit certain income levels. So we want to be sensitive to all those things. We model all those before we pick the right number for a Roth conversion so that we know exactly how we're threading this needle to increase our income and obviously increase our tax liability, but not do it in an unexpected way.
From the outside looking in, it seems like the math can really be favorable, but only when the rules and really the downstream effects are accounted for.
That's how we size a conversion. We start by estimating the current year income and deductions so we can project taxable income.
That really tells us your marginal bracket and how much room you have before you reach the next bracket.
With that room measured, we choose a conversion amount that stays within the target bracket after accounting for all the other income. For lower income earners, we're not afraid to push through even the 22 or 24% bracket. Before we lock it in, we review the potential side effects possible, Medicare IRMAA surcharges, how much Social Security will be taxed, to state taxes, capital gain stacking, and any phase-outs.
And then we run it once for this tax year and revisit next year when we know the new numbers and the new rules.
Yeah, it's really dangerous policy to say I'm going to run tax strategy and Roth conversion multi-year out. People do request it all the time, and they say, hey, if I pay you to run the next 5 years conversions, can you do it? We won't even do it because the data can be so inaccurate down the line. We don't know what tax rules are going to be in the future. Yes, we do have sort of tax foresight to know that the next couple of years it should be this and this, but you never know what changes will come down the pike. And obviously we don't know what incomes are going to be. So we don't know. You win the lottery next year, that's going to dramatically change how we're going to think about conversions. So running conversion 2, 3, 4 years out is just really a fool's errand and not something we're even willing to do. So let's walk through a few common situations here. If you've received retirement and not yet collecting Social Security, that's often the most favorable window. We'll typically execute a single kind of right-size Roth conversion for that current year, and then we'll reassess in future years.
And listeners who are already on Medicare and already receiving Social Security.
Yeah, in that case, of course, conversions still work. We just want to be careful. We just want to thread that needle. We may size them a little bit more conservatively because we want to be sensitive to the impacts of Social Security and IRMAA.
And what about a year with maybe unusually high income, maybe a business sale, big bonus, or honestly, maybe you won the lottery, like you were saying?
Yeah, hit that big jackpot in Vegas. And that's, of course, something that we're always sensitive to. Very often, we will just skip conversions. We just won't do the conversion in that year because they're already in the highest brackets, and we don't expect they will be in the future. So why are we prepaying very high taxes now when we know next year there's a high probability we're going to be paying a much lower tax rate? So in that case, we will probably just completely defer and skip that Roth conversion year.
How does charitable giving fit into all this?
It can fit great. It can be a really important part of our strategy. A well-timed current year conversion paired later with a charitable distribution at retirement age lets you spread taxable IRA dollars strategically while preserving the Roth and tax advantage flexibility for your legacy. We may even do something like a donor advised fund, make a big charitable deduction to reduce your income in this year, and then use that space to convert in that same year. So if charity is on your horizon as something that's important to you or something that you really want to make sure you're prioritizing, a Roth conversion can play really nicely into that strategy. Let's talk about getting started. First, pull together your current year numbers. Look at your wages, look at your income, your pensions. You want to pull everything together, every dollar that's going to be taxed that you're going to earn in this year to come up with your adjusted gross income. And that's ultimately what we're looking for.
Right. We need that snapshot to see how much room you have before you hit the next marginal bracket.
Next, let's complete the Roth conversion fact finder. You'll find that on our show notes. It lets us model your bracket room so we can say how much space you have before we start hitting thresholds, whether it be for Medicare premiums, next brackets, and your Social Security tax. Next, we want to schedule a planning session. We'll coordinate with the CPA and recommend this year's conversion amount and just revisit it annually. It's something that every single person should be thinking about every single year, especially if your income is such where you're in the 24% bracket or lower.
Conversions can be a powerful tool when they're sized and timed correctly. Understand your current year numbers, respect the rules, and make deliberate choices. And also, be sure to subscribe so you don't miss any upcoming episodes. And if this helped, a 5-star review helps others find the show as well.
We really appreciate your 5-star reviews. We don't appreciate any 4-star reviews or less. So.
Leave us alone.
That's right. You should listen to a different podcast if that's where you want to go. But until next time, guys, stay intentional, stay on course, and make sure you keep planning. Thanks so much.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.